Enable.
Welcome to Season 5 of NSE FinWiz, powered by CNBC TV 18, and I'm your host Nithya Balakrishnan. Today is a very special episode as my team and I have travelled to an educational institution, the Manipal Global Academy of BFSI in Bengaluru.
Manipal Global Academy of BFSI is a leading corporate university imparting quality education in banking and finance. Drawing from its expertise and experience in managing several education institutions of repute, this academy offers holistic training of young minds from across the world to sharpen their core competencies in making a career in the BFSI space. NSE FinWiz arrived at the academy in Bengaluru and met its students to reiterate the importance of focusing on personal finance to secure a healthy financial future.
Efforts like NSE FinWiz are an excellent effort at promoting this financial literacy. It encourages dialogue, it encourages sharing, it encourages the habit that you need to be literate in a common sense of the term. You don't have to go become a technical expert on anything. NSE FinWiz does a wonderful job of connecting people, getting experts down to talk to people who suddenly thought all this was Greek and Latin.
Money is the basic foundation of any human being. So it is but obvious that there are two parts to it. One, you earn, and two, probably invest in secured, sound, return-oriented way. So at the end of the day or at the end of the twilight, you have probably enough money in your coffer.
Wealth management is important. One reason is because it generates a parallel income for an individual. And the second reason, it also helps maintain the same lifestyle post-retirement.
Hello and welcome to Season 5 of NSE FinWiz, powered by CNBC TV 18, and I'm your host Nithya Balakrishnan. Today we're at the Manipal Global Academy of BFSI, and joining me are Lavai Navlaki and Kalpesh Ashar. Thanks so much for joining us on the show. Well, right away I'm going to say each one of us in this room works hard to make money, but Kalpesh, if you can tell me how important is it for that enabling the money to work for you?
When we say that I save money, what you're doing is just keeping your mind happy with it and having an emotion which keeps you happy that I'm a good saver. But when that saving emotion translates into action, we call it investments. And that action has to be very thoughtful, because that is going to go into a very thoughtful investment which is going to make your money work harder for you. So there's a myth that I'm a good saver. You're not a good saver, you have to be a good investor. A
lot of us set aside an amount of money every month, but where do we park those funds in order to be smart investors?
So mutual funds are a good investment vehicle. They don't necessarily, I know they're youngsters, so typically we tend to tell them that there's long period of time, go into equity, etc. But even if they just went into money market funds, it will be a good start, because they're first making sure that they're not spending the money.
So if I were to ask you, is insurance an investment, what would your answer be?
Straight no. So insurance, in our country has always been perceived more as an investment vehicle rather than a pure protection vehicle. And we all have been surrounded by, all these traditional plans and the endowment plans and earlier versions of ULIPs. So those ones are the ones which have actually not let the adequate cover come into the picture of an individual in terms of the life cover, nor 100% has it given any type of returns which you can call substantial or even above average. If you see the returns of these policies in terms of the investment context, it's in a range of anything between 3 to 7%. It's always been that, and that's quite dismal, to say the least. So this is a myth which we need to clear first, and even tell people, spread the word around, that the term insurance policies are the way to go and nothing beyond that.
Absolutely. Lava, if I can ask you to jump in, a lot of us believe that if I'm putting an X amount into an insurance cover, at least, an endowment plan, at the end of the time, even if nothing happens to me, I will get a lump sum back. But is that a smart way of looking at things? Or would you also suggest a term policy where if nothing goes wrong and that's what you want, then it's almost like just setting it aside and forgetting that the money went away?
Yeah, so I think one needs to understand the concept of insurance. The insurance is essentially replacement of economic value of a person. So let's say I am contributing 10,000 rupees every month to my family. If I am not there, imagine, I know it sounds bizarre, but imagine an ATM giving out that 10,000 rupees a month. It won't replace the emotional value, but it takes care of the economic value. If I am contributing that amount, then I want the maximum possible term cover so that I can make sure that that amount is taken care of. So from that point of view, yes, better to take a term cover. If you have lots of money, then maybe you can look at some of the insurance products. There is a tax-free element of it that attracts people. But I think that's not really relevant for people who are just starting their job.
How much percentage of a person's salary, of a person's savings, should actually be set aside to be invested into the equity markets?
I think it's important that people understand when they are investing in equity, that they are looking at it from a long-term point of view, number one. Number two is to make sure that they don't enter the equity markets all at one time. So they sort of stagger it. Just these two simple things if they were able to do. And third, if they had regular savings and money available for investing, then they could make sure that they are entering it on a regular basis. These two or three things will bring down the risk and then make them get the benefits of equity.
Well, we are chatting in the months of Jan, Feb, March, and this is usually when, the HR across companies in the country will send you mails regarding investment proofs, and then you'll realize, okay, tax exemption is something I should have done and I can do and avail. So let me figure out where to park the funds and then go pick up the first or second or third insurance policy that comes your way. How would you think, is this even smart? How would you avoid this situation if you were a young investor?
So first and foremost, not wait till Jan, Feb, March. This is something that you do at the start of the financial year. Make sure that you put aside enough money for that term policy. Definitely look at your pay slip. If you are in a company which is deducting provident fund, then that's also helping you from tax point of view. So sometimes people go and invest in these tax saving products without realizing that they've already got the tax saving available through their employment. And then they're doing it because somebody else told them that it's a tax-saving product.
All right, on that note, the word coming in from our financial experts is insurance is mandatory, but it's financial protection and not really investment. Stay tuned, we have a whole lot to discuss on the other side. Welcome back. We're still in conversation with Kalpesh and Lavai. And this time we're going to talk about how important it is to set a goal before you start planning your finances. Because if I walk into a gym, Kalpesh, I'm going to think, okay, my target is, maybe lose 2 kilos over the next 3 months. And it becomes easier to achieve it. How important is it to set similar goals when you start out to plan your finances?
Goal setting is very important. And in financial planning, that what we endeavor to do is channelize your investments and the investment products which are supposed to meet your goal. We are not astrologers, we are planners. Even we do not know what's going to happen 10, 15, 20 years hence. But at least by setting out a roadmap, that's what we do. And in case there is some event, some thing which don't work out, but at the end of it, if you see, I'm sure a person would have achieved 75 to 80% of his target.
How important is it to split it into what do I need now, 5 years from now, 10 years from now, maybe 40 years from now, and how would you advise a mixture in diversification of asset portfolio along the ride?
Your goals actually are just your dreams and desires. So if you were to imagine life and say these are all the things I am dreaming, this is what I desire, I think it's a good idea to just write that down first. Then try and convert that into money terms, which is how much money do I need for that particular dream. Once you put all of this down, it may be a good idea to approach a financial planner because they will look at things from an inflation adjusted point of view and then see what is your liability or commitment that's happening over different periods of time over your lifetime. Once we've got that in place, then we look at what you've already got by way of asset, what you are likely to get in future, which is your income minus your expenditure, and how is it that is going to grow. You can take an estimate. By putting all of that together, you'll probably arrive at a number or a rate of return that's required overall on your portfolio That will help you achieve all the goals.
Well, which is why I'd like you to answer this query of Vijay Raghavan, who is 25 years of age. So, the corpus is close to 2 crores. On a monthly basis, can set aside 10,000 rupees, 35-year time horizon.
Assume you want, your target is 2 crore, I'm working on a platform of 5 crore. Okay, that would be a desirable amount, dream amount for many of the people at the age of 60 if they could have 5 crore with them. Now the mathematics is that if you're earning a CAGR of 12% per annum, so if you are at the age of 30 and you start that exercise, you have a clear 30 years to do that. You would just require an SIP of 14,000 rupees per month. You defer that decision by 10 years. You would require 50,000 rupees per month. It's gone up almost 3.5 times. So start early is the mantra with whatever amount as per your comfort zone, as per your cash flow.
Well, Lavai, if I can address this query of Naveen Bhatt.
Predominantly investing into equities as well, a little bit of it. But just wanted to understand from you, corpus of about 2 to 3 crores before about 45 to 48, and monthly savings of about 20,000 rupees. Is it possible?
Because you gave a very wide range of 2 to 3 crore. That's a 50% higher or lower number. I think the important thing to understand is that quantity enough for whatever goals you are planning in your retired life, if that is your retirement time, or is it a time where you are going to really pursue your personal dreams and earn much less, then in which case you also need to factor in what you are earning at that point in time. The cost that you are incurring today, even if inflation was running at say 5 or 6% per annum as we can think, and say 25 years later, whatever you are spending today will be 4 times that amount is what you will spend. I think you need to have a goal which is an objective goal. That why do you want that money rather than this is a quantum I want.
Now, if I can actually bring in Megha Satyanarayana into the conversation.
Question to you, sir, is a term plan better or a ULIP considering the youngsters?
We generally assume that 10 to 12 times of your annual income should be your term cover for the least. Then you get down to how much are your assets, your liabilities, and increase or decrease the term cover accordingly. Now compare the 10,000 rupees, which is hardly 800 rupees per month. I think anybody could afford that for that maximum cover, albeit considering that your health is in the right shape. Now compare it to a ULIP. ULIPs have had a lot of problems establishing themselves in the right way. They had established themselves with a lot of other reasons. And that's why the financial authorities came on them very hard in the last 2-3 years, saying that it was an opaque product and the costs were too high. It was a fact. And there was very less transparency into what you were investing. So if you were to do an investment call, why not go into a product in which you have a total transparency?
So on that note, we'd like to slip into a quick break right here on NSE FinWiz, but a whole host of personal finance queries answered on the other side. Welcome back to Season 5 of NSE FinWiz, right here from the Manipal Global Academy of BFSI. And it's time to throw the floor open for personal finance queries. If I can have the microphone to the lady in blue right in front, please.
Sir, you were talking about term cover, life insurance term cover, and how much life cover one should take. Right, so you said approximately 10 to 12 times of your annual income. Right, so I have a question. Should I include my outstanding debts in that, or those debts should be covered itself? So how do I go about it? It's life cover only for annual income, or should I include debt?
100% you should include your existing debts, because those are to be repaid. In fact, when you take a loan, a home loan, the bank insists that you should have a term loan covering it also. So that is a given, that apart from the cover which is estimated for you, which is required for you, you should cover your debts as well. So don't keep those aside, because if for an eventuality happening, the burden or the onus of repaying falls onto your family, and you don't want that unhappy situation where it eats out of the normal term plan which you've covered, thereby leaving a gap in what is actually left in the hands of your family. So please cover your debts, liabilities, whatever it is, in the term plan, or a standalone cover also is good enough. a term plan for that purpose.
Well, can we have the gentleman with the purple tie?
My question is, generally youngsters are of speculators. They want shortcuts to find good returns. So sir, my question is, how can we play as a arbitrator or hedger in securities market?
So I think the important thing is that for you to get experience of the market, right? Because you are a speculator, you want to experience the market. The way to reduce the risk on that is essentially limit the amount that you are putting aside over there. So restrict the amount that you are putting aside which is not linked with any short-term goal of yours, and then make sure that only that quantum of money you are putting in the space to speculate. That's one way to do it. I can't tell you that stop doing that because you'd like to do it. So do it, but restrict the amount. And that's probably one easy way of ensuring that you don't go overboard.
All right. Can we have the microphone to the lady about 3 seats from you?
My question is that what should be the ratio of allocation of our money in investment and insurance, as we can't compromise to our present for our future?
The ratio, let's not talk about insurance for sure, because that's a must. So whatever is the required amount to be set aside for an adequate insurance has to be paid. And that, fortunately for us, in a term plan is not much for anybody's wallet. So if you, as I explained to you earlier, that even if you need to be covered for 1 crore and you're 30, you'll just pay a premium of 800 per month, which is 10,000 per annum. And that's not going to pinch anybody's pocket. So that takes care of the insurance part. You're not looking at a return from that. Coming to investments, ma'am, what I would look here is that you're always looking at FD as a fixed return of investment. Yeah. But we've always been harping on the fact that you're not looking at inflation. In fact, there's been an exodus of lots of people who have understood that FD returns are not sufficient. Why people are shifting from FDs in the last 2-3 years, where the rates have been either stagnant or coming down, into better options. But here we would like to sound a caution here that do that after people have understood, professionals have understood your risk profile. If your risk profile demands conservatism, remain invested in FDs or max move to debt funds. If it is surplus money of youngsters who's lying in FDs, then that's the time, if they've got time on their side, it's high time you all shifted to equity. So it depends on your personal profile. And when you say FD is secure, inflation at around 4 to 5% is not a good return. Your FD return at 4 to 5% just on the line of inflation is not good.
It's not a good return, but it is an assured return that we will get. But in investment in equities, it is a very risk that what we are investing may not be.
So that's what they said. When you stay invested in the long term, the chances of mitigating those risks,
so
come
if you
down
keep an
significantly.
FD for 5 years, even in an equity, we've had records that in 5 years, at least you would get inflation beating returns in a debt fund.
Well, on that note, we're absolutely timed out on this episode of NSE FinWiz. Kalpesh Ashar and Lavai Navlaki, thanks so much for joining all of us here at the Manipal Global Academy of BFSI. And from all of us here that put the show together, thanks for watching.
It was very informative. It did reinforce what we at Manipal Academy of Banking do teach our students in terms of insurance, in terms of investments, and a good first-time experience for our youngsters who are going to be starting their jobs.
The session was extremely exciting. It gave us a lot of inputs in how to go about investing. It makes a point for sure that youngsters have to start their investments early, and the early the better. I think that communication will go into the youngsters in the classes as well.
Focus, ideate, innovate, enable.